Thank you, Ricardo, for that very kind introduction, very comprehensive. And thank you all for having me aboard. I was absolutely chuffed with the invitation to be back. So just by way of very brief introduction, EFIC is Australia's export credit agency. That means we provide financing to Australian exporters like yourself, with a private banking market, not so much. So we often find that exporters are on the front line of global economic conditions, and as part of the economics team, it's my job to know what opportunities and indeed what threats lie on the global horizon. So in that vein, I've been invited along today to provide you with a very brief, high-level, helicopter-type overview of the global economic outlook, and in particular how we think China's economy will continue to impact on wine exports. So the good news is that the global economy is enjoying a period of very strong growth. The bad news is that expansion looks to have peaked in some key economies, and it's becoming increasingly fragile. So as economists love to say, the risks are to the downside. But despite all that, it's coming through very clearly this morning, and it smacks you in the face when you download the data, that Australia's wine exports are absolutely booming, driven in particular by Chinese demand. So China's exports $1 billion last year. Well done you. That was a fourfold increase on 5 years earlier. The Chinese market now worth about the same as the next three largest markets combined. We believe that owes to four what we think will be enduring tailwinds. So in China, we've seen middle-class income growth, business market and friendly business market reforms, improved market access, and on top of that, we've got the continuing competitiveness of the Aussie dollar. So we think that to varying extents, all four of those macro tailwinds will endure. So that was just a brief teaser. You get excited, and I will jump in. Okay, so global growth is expected to peak at about 3.9% this year and next, and that would be its fastest pace since 2011. So that very positive short-term outlook, it's being driven by a cyclical recovery in consumption and investment, and that in turn owes to highly supportive, albeit temporary policies. So firstly, monetary policy is expected to remain easy by historical standards, and that's despite continued US Fed rate hikes. That largely owes to sluggish employment despite sluggish inflation despite still low unemployment. And second, fiscal policy has become highly pro-cyclical and highly stimulatory. But as the global cyclical economy approaches its 2-year mark in terms of upswing, the current pace of expansion has become less synchronised. So in particular, the US expansion is expected to strengthen this year, but the economies of China, Europe, Japan, all expected to slow. So you can see in the second chart that the light grey line, which depicts 2018, the IMF's forecast becoming decidedly less rosy in the out years. Now, consistent with that global growth story, global trade volumes expanded at their fastest pace since 2011 last year, but also, unfortunately, consistent with that global growth story, there are early signs that trade volumes are plateauing. You can see that from the edge of the first chart. Indeed, growth expected to moderate from 4.7% last year to about 4.4% this year for next. Now, that outlook, I think, is really important to mention that it's still well above the post-crisis average, which is about 3%, but we are well down on the trade volume growth that we were seeing before the GFC, which ran well over 7%. Now, to understand the global economic and trade outlook, it's obviously really important to look at the individual countries that are driving the headline figures. You can see from that first chart that China is set to remain the most important engine of global growth. It'll account for about 30% of the global total over the next couple of years. Now, China did bounce back in 2017 after a pretty rough couple of years that were marked by capital outflows and tightening financial conditions, but we have seen in recent quarters that growth is starting to slow. Indeed, new data last week told us that fixed asset investment growth is now at its slowest pace since records began in 1999. And indeed, we think that overall growth slowdown story will continue. It's expected at 6.6% this year, which would be its slowest pace to growth since 1990. So that owes to two factors. First of all is regulatory tightening. After years of highly intensive, credit-intensive growth, China's debt has mounted. There are increasing evidence that policymakers are finally starting to prioritise financial stability over growth targets, and we think that policy tightening is absolutely critical to curtailing the debt-related vulnerabilities in the economy, but of course it's going to drag on investment and it's going to drag on growth. Our second headwind is trade tensions, which are dragging on external demand. So that's despite the fact that China's economy is now less dependent on exports than it was 10 years ago. In fact, goods exports to the US now equate to just 4% of GDP. But despite this very engineered and this very enduring slowdown, you can see from my second chart that China's real GDP output remains strong, and that owes to the enlarged size of the economy. So indeed, China's 6.9% expansion last year saw it grow by the size of Canada's entire economy in PPP terms. So if China accounts for just over a third of wine exports last financial year, if we add in the US, the UK and Europe, that total bumps up to almost 90%. And you can see from my first chart that these are also important additional countries in terms of constituting an important chunk of global growth. And so I think it's just worth dwelling here for a couple of slides before we get back to China. So upward revisions to IMF global growth forecasts have really centred on the US recently. So growth here has been absolutely terrific. The current US expansion is now one of the longest on record. You can see from the chart that in contrast to Australia's other major trading partners, economic momentum is actually expected to strengthen here over the next couple of years. Growth expected at 2.9% this year. So that owes to strong consumption given buoyant asset prices, strong consumer confidence, and also the tight labour market. You can see from the second chart that unemployment has actually dropped below 4%. It's now at its equals lowest level in 50 years. Business investment is also robust, and that owes to major tax reform. We've still got supportive financial conditions and also higher oil prices. But the sugar hit of stimulus is absolutely temporary, and so the US economy is expected to wane over the back end of the forecast horizon. There's already indications that business optimism about fiscal stimulus is being offset about uncertainty regarding trade policy. And of course, higher US interest rates will take the steam out of consumption and housing investment. So my first chart shows that the UK consistently outperformed the majority of its G7 peers prior to the Brexit referendum. But as Theresa May is beavering away at the pretty colossal task of balancing the competing demands of the pro and anti-Brexit members of her government, all while she is trying to draft an exit deal which is acceptable to the EU, well, the economy is stagnating. So in particular, business investment last year was less than half that which was expected before the Brexit referendum. The UK economy as a whole is expected to eke out growth of 1.5% this year and next. As for the EU, for the first time since 2007, all member economies saw their economies expand last year, and that blockbuster performance was absolutely export-led. But the pace of growth has cooled in 2018. Indeed, we have recent data which saying that the pace of growth is at its slowest in the last 2 years in the second quarter. You can see from the table that weakness is really expected to continue as monetary stimulus is withdrawn and as global trade growth eases. So perhaps just a quick stock take so far. So global GDP and trade volumes are strong, but while stimulus will see the US economy continue to outperform this year and next, other major economies definitely losing their stride. And I think I must note here that the downside risks are absolutely becoming more salient. That's mostly because I'm a country risk assessor, which literally means I'm paid to worry. But I thought I'd share 3 key issues that crowd our worry list, and I must note that these are interrelated. So if one eventuates, it could trigger the others. Our first worry, of course, is trade disputes. Announced and anticipated US tariffs have triggered sort of retaliatory tit-for-tat measures by major trading partners, and that's elevated the risk of an escalating trade war. higher trade barriers, they make tradable goods less affordable, they disrupt global supply chains, they slow the spread of new technologies, all of which has rather disastrous impacts on productivity. Indirectly, you can see from the first chart that escalating trade policy rhetoric has spiked uncertainty, and that has disastrous impacts on business and financial market sentiment, which dents investment. So IMF modelling has been done recently. They say that if all realised trade policy threats are realised, global GDP could be about 0.5% lower than current projections by 2020. That might not warrant all the current media hysteria, but we do think that risks around America First trade policies will increase, particularly in the run-up to midterms, and because the US current account deficit, which is the very thing that President Trump is so keen to eliminate, well, that should only increase as a result of his fiscal boost. Now, from a domestic perspective, Australia's input into trade between the US and China is actually pretty small. It's about 0.4% of our GDP, but we are a small open economy, and so descending into an all-out trade war would absolutely most definitely hurt. The Productivity Commission, they've recently done some modelling. They say if everyone hikes their tariffs by 15 percentage points, well, the global economy would fall into recession. Australia's GDP would fall by about 1%. Importantly, about 5% of the capital stock would be mothballed, which means that about half of that investment during the mining investment boom is suddenly no more. So my second worry is financial volatility. You can see from the second chart that a decade of ultra-low global interest rates has encouraged a pretty unprecedented debt binge, particularly in emerging markets. So credit risk might be constrained while global growth momentum is strong, while borrowing costs are low, but the Federal Reserve is on track to continue hiking rates over the next couple of years. So higher interest rates will divert government funds towards increasingly hefty interest payments, and that dilutes growth. But tighter financial conditions could also see disruptive flows and movements in exchange rates and capital flows. And that's particularly to emerging markets with weaker economic fundamentals or indeed political risks. So economists have been banging on about this risk for the better part of 2 years, but there has been a certain level of indication over the past couple of months, first with the Argentinian currency crisis and more recently, obviously, with Turkey's troubles. Now, my third bucket of risks is geopolitical tensions, which I must admit is cheating a little bit. It's quite a large catch-all bucket. But for instance, it includes the fundamental political challenges that we're seeing in Europe at the moment regarding fiscal governance and things like migration. Indeed, the sell-off in Italian bonds that we saw in May was a pretty stark reminder to economists about the very thin buffers at the national level and the pretty deep structural challenges there. So I think that's enough pessimism. So downside risks aside, the base case is really that the fundamentals of Australia's bumper wine exports will endure. And we think that owes to 4 macro tailwinds that I'll go through very briefly. So the first is China's economic rebalancing. It's moving away from commodity-intensive, investment-driven growth towards a more sustainable consumption-driven model. Indeed, consumption accounted for about 60% of China's GDP last year. So now already China is home to the world's largest adult middle-class population, but the Brookings Institute reckons that China's middle-class population will add an extra 350 million people over the 7 years to 2022. That's equivalent to 2 times the Aussie population added to your target market every single year. That burgeoning middle class means that even despite China's much-hyped economic slowdown, the outlook for discretionary consumption is still really strong. So the second chart shows that between 2015 and 2030, China's consumption will almost triple to $14 trillion. So middle-class households, they're seasoned, they're sophisticated shoppers, and they're able and willing to pay a premium for quality discretionary goods. And so what we term consumption upgrading has occurred. I think wine provides the absolute perfect example of that phenomenon. You can see from the first chart, which is a variation of Peter's earlier, that Australia's exports of premium wine to China doubled last financial year, and that growth well ahead of other price points. We're also encouraged by the fact that compared to countries with similar incomes per capita, China's wine consumption per capita has considerable room to grow. So that's the red dot converging on the black line, which is the average. We think that perhaps reflects the older generation preferring rice wine, while the younger generation is trending more towards wine from grapes. And given that 50% of China's population was born after 1975, well, that all certainly bodes well. So my second macro tailwind is improving market access. And as Peter said, Australia's competitiveness will absolutely, obviously, improve as wine tariffs are completely eliminated from January next year. You can see that in my first chart, the downward trajectory. So that will see Australia compete on an even keel with our competitors from Chile and from New Zealand, who are already enjoying preferential market access under their free trade agreements. But second, market access will also improve consistent with a surge in online sales. China's internet users more than trebled over the decade to 2017. You can see from the chart that China has the world's largest online retail market. It has 700 million internet users, 282 million digital natives. So that's basically internet users that are less than 25 years old, basically that generation that didn't know the brilliance of Snake on their Nokia 3310s. And that online market, very much dominated by Alibaba, but foreign retailers have shared in its success. So for instance, during Alibaba's 24-hour Singles Day event last year, Chinese consumers purchased a whopping 33 billion worth of goods. That's literally enough to buy Iceland or Paraguay. It's also a 40% increase on a year earlier. And Australia ranked third in terms of international sales, I believe, behind the US and Japan. So that growth very much being encouraged by cross-border e-commerce pilot zones, which are lowering the barriers to purchasing overseas goods online. And that growth will continue with new partnerships. I was really encouraged to hear about an MOU recently signed between Wine Australia and Alibaba, which will continue to showcase Australian wine on fast-growing e-commerce platforms. So tailwind number 3, we think that China's business-friendly reforms will continue to support Australia's exports into the medium term. The first chart shows that China improved to 78 of 190 economies in the World Bank's latest ease of doing business gauge. Indeed, all Australia's large EM trading partners improved, represented by the green bar, South Africa. So for instance, on the upside, China ranks 5th for enforcing contracts. Indeed, Shanghai and Beijing now outperform the US in terms of the time and ease it takes to enforce a contract, though challenges absolutely remain. So China ranked 97th in terms of trading across borders. It takes an average of 72 hours and about $800 to comply with border requirements for import into Shanghai, and that compares with about 9 hours and $100 into a typical OECD country. So still some way to go. Whoops, sorry. So my last tailwind is continued competitiveness of the Aussie dollar. So despite pretty strong iron oil prices and coal prices over the front half of the year, the Aussie this morning, I think it rounded to 73 US cents. That means it's down about 9% against the greenback since its late January high. Now, the future trajectory of the Aussie dollar depends on 3 key variables. Number 1 is relative interest rates in Australia and the US. Number 2 is future commodity prices, and in particular coal, iron ore and LNG, and related to that, China's economic industrial performance. And third is the risk appetite of financial markets. Now, forecasting foreign exchange, notoriously seriously perilous. I've included that rather wonkish quote to illustrate that point to you. But for what it's worth, markets do expect the Reserve Bank of Australia to stand pat this year where the Federal Reserve continues to hike interest rates, and Aussie government forecasts see the prices of Australia's key commodity exports falling about 15% next year, all of which will obviously drag on the dollar. For what it's worth, the forward curve suggests that markets think the Aussie will remain at about current levels over the next 2 years. So these 4 macro drivers very much prompting Australia's export profile in its entirety to rebalance from mining towards non-resources, and we certainly think that wine will continue to remain on the positive side of the ledger. I think that's a great time for the macroeconomists to exit and the wine exports to take over again. We do have an epic foot soldier here today in Andrew Perkins. I'm sure most of you have had him knocking on your door. He and myself will be here for various portions of the day. If you do have a question, absolutely tap one of us on the shoulder. Thank you.
Questions?